Hello, in this video, we'll discuss legal liabilities of auditors and accountants under common law, as well as statutory laws for lawsuits brought by clients and third parties. There are four general stages in audit-related disputes. It starts off with events that result in losses for users of financial statements. It's followed by an investigation by plaintiff attorneys to link the user losses with the allegations of material omissions or misstatements of financial statements. The third step is the filing of the lawsuit, followed by the fourth step of final resolution of the dispute. Auditors can be sued by clients, investors, creditors, and the government, and can be held liable under common law as well as statutory law. So what's common law? Common law involves some legal opinions issued by judges in deciding a case. And then these opinions become legal principles that set a precedent and guide judges in deciding similar cases in the future. Statutory law, on the other hand, is legislation passed at the state or federal level that establishes certain courses of conduct that must be adhered to by parties. Now, breach of contract is a claim that accounting or auditing services were not performed in a manner prescribed in the contract. This type of claim is typically brought by clients who are party to the contract with the auditing firm. Legal action brought by clients and users of financial statements or other civil complaints covered by tort acts. This includes fraud, deceit, and injury. Common law, as I just mentioned a moment ago, evolves from legal opinions issued by judges in deciding a case. These opinions become legal principles that set a precedent and guide judges in deciding similar cases in the future. Under common law, auditors must perform professional services with due care, which they can demonstrate by having exercised the same degree of skill and judgment possessed by others in the profession. Another way auditors can demonstrate that they exercise due care in the audit is when the auditors follow generally accepted auditing standards. Due care also includes exercising the degree of professional skepticism expected in the audit of financial statements. Lawsuits for damages under common law usually result when someone suffers a financial loss after relying on financial statements that are later found to be materially misstated. These cases are often referred to as audit failures. Audit failures include all possible causes such as breach of contract, tort, deceit, and fraud. An accountant or auditor has a contractual obligation to the client that creates a so-called privity relationship, which was established by the 1932 Ultra-Maris case. The client can bring a lawsuit against an accounting or auditing firm for failing to live up to the terms of the contract, but the client or plaintiff must be able to demonstrate that they suffered an economic loss, that the auditors breached the contract, that the auditors failed to exercise appropriate level of professional care, and that the auditor's breach or failure of care caused the loss. In addition to breach of contract, auditors may be liable to clients for tort liability that ranges from simple, ordinary negligence to fraud. Fraud includes gross negligence or constructive fraud that represents an extreme or reckless departure from professional standards of care. In the 1932 case Ultramaris versus Touche, Justice Benjamin Cardosa stated that accounts must be prepared to compensate all foreseeable victims whose economic losses are approximately caused by the account's negligent statement, thereby creating the first common law legal liability standard for auditors known as the privity or near privity rule. Let's now talk about professional negligence. Professional negligence is the liability theory most often referred to as an accounting malpractice claim. The elements of a professional negligence action against an accountant are similar to those present in any type of negligence lawsuit. Duty: the accountant must have owed the plaintiff a duty to use reasonable care in delivering accounting services. Breach of duty: the plaintiff must show that the accountant failed to use that degree of skill and learning normally possessed and used by public accountants in a similar situation. Damages: the plaintiff must show that he or she suffered damage as a direct result of the accountant's breach of duty. And causation: the causal nexus between the asserted breach and damages, such as a business driven into bankruptcy because it went into debt in reliance on overstated financial statements. Now, contributory negligence of the client can be regarded as a defense to the liability of the account for malpractice. However, it has to be proved that the negligence of the client has proximately contributed to the accountant's failure to perform. Even then, the client's negligence is a defense only when it has contributed to the accountant's failure to perform his contract and to report the truth. The comparative negligence rule, on the other hand, is a compromise and replaces the harsh all or nothing approach of contributory negligence with a formula based upon allocation of fault. It doesn't mean if both parties contributed to the issues that the auditor is not still at fault. Courts now allow accountants to claim a comparative negligence defense and allow the jury to apportion damages between the accountants and the corporation. Auditors' actions can go beyond negligence. Recklessness involves actions that fall just short of actual intent, but are greater than simple negligence. Consequently, recklessness carries a greater liability than negligence. There are two tests to determine recklessness: the subjective test, where we ask what the auditor knew or is believed to have been thinking when the act occurred, and then there's the objective test, where we ask what a reasonable person would have thought in the defendant's position. Negligent misrepresentation happens when the auditor or accountant gives false financial statement information to a third party, and the auditor knows that the third party reasonably or foreseeably relied on the audited financial statements. Auditor liability for negligent misrepresentation does not require proof of the audit that was intended to influence the plaintiff. Complaint for negligent misrepresentation is sufficient if it alleges that the audit was intended to influence the classes of persons to which the plaintiff belongs. The Ultramarines decision established a strict privity standard, which included only foreseeable parties. Subsequent court decisions, though, moved away from the strict privity standard over time to include foreseen and reasonably foreseeable third parties. The New York Court of Appeals expanded the privity standard in the case of Credit Alliance versus Arthur Andersen and Company to include a near privity relationship between third parties and the accountant or auditor. In the case of Credit Alliance versus Arthur Andersen and Company, Credit Alliance was the principal lender to the client and demonstrated that Andersen had known that it would rely on the client's financial statements prior to extending credit. And it's not that straightforward, though. The case established tests for holding auditors liable for negligence to third parties. First, the auditor must have knowledge that financial statements would be used for a particular purpose. Then, there must be an intent of the third party to rely on the financial statements. And third, there must be an action linking the accountant and the third party that proves that the accountant knew of the third party's reliance. Like in the Credit Alliance case, where there was communication between Credit Alliance and Andersen. Subsequently, in the 1992 case of Security Pacific Business Credit Inc. versus Pete Marvick, Main and Company, this last requirement of an action that links the auditor to the third party was even more emphasized in that it stated that the third party must be known to the auditor. The near privity test here is that the auditor must directly convey the audited report to the third party, or The auditor acts to induce reliance on the audit report. Beyond privity or near privity relationships, most states limit liability to limited groups of third parties whose reliance is actually foreseen, but they're not necessarily known to the auditors. This so-called middle ground approach was used in the 1968 Rouge Factors versus Levin case, where Rouge had requested financial statements prior to granting a loan. The auditors audited the financial statements, which showed that the client was solvent when in fact the company wasn't. After the company went into receivership, Rouge sued. In this case, the requirements of near privity were not met, but the Rhode Island federal court held that an accountant can be liable for negligence to a third party not in privity of the contract. The case relied heavily on the second restatement of the law of courts. So what's the second restatement of the law of courts? The second restatement of the law of courts approach, sometimes known as Restatement 552, expands an accountant's legal liability exposure for negligence beyond those with near privity to a small group of persons and classes who are foreseen or should be foreseen by the auditor as relying on the financial information. This is known as the foreseen third party concept, because even though there's no privity relationship, the accountant knew that that party or those parties would rely on the financial statements for a specified transaction. In some state court decision cases, such as the 1986 Bluebell Inc. versus Pete Marvick Mitchell and Company case, a less restrictive interpretation of Section 552 has been made. In the Bluebell case, the Texas Court of Appeals held that if an accountant preparing audited financial statements knows or should know that such statements will be relied upon, the accountant may be held liable for negligent misrepresentation. The third judicial approach to third-party liability expands the legal liability of accountants well beyond ultramarines. The reasonably foreseeable third-party approach results from a 1983 decision by the New Jersey Supreme Court in Rosenblum Inc. versus Adler. The New Jersey Supreme Court ruled that auditors should be liable to all reasonably foreseeable third parties who rely on the financial statements, and stated that independent auditors have a duty of care to all persons whom the auditor should reasonably foresee as recipients of the statements for the company for proper business purposes, provided the recipients rely on those statements. Another important case that followed this approach was Citizen State Bank versus Tim Schmidt and Company. In this case, the bank sued the public accounting firm after relying on financial statements for one of its debtors that had been audited by Tim. The Wisconsin court used several reasons for extending auditors' liability beyond privity. The Wisconsin court ruled that the cost of credit to lenders would be prohibitive, and foreseeable third parties could not sue auditors. Since 1987, though, no state high court has adopted this foreseeable approach to accountants' legal liability, while a large number have approved or adopted one of the narrower standards. For example, in its 1992 ruling in Biley versus Arthur Young, the California Supreme Court expressly rejected the foreseeable approach in favor of the Rouge factors or restatement standard. The court stated that the foreseeable rule exposes auditors to potential liability more than their proportionate share. However, in its 2003 ruling in Murphy versus BDO Seidman LLP, the California Court of Appeals ruled that grapevine plaintiffs who alleged indirect reliance based on what others, for instance, stockholders and stockbrokers, told them about the financial statements, had legal claims for ordinary negligence against the auditors, as long as the auditor would reasonably have foreseen that stockholders or stockbrokers would tell other people of the content of the financial statements, and that the other people would rely on the misrepresentations in purchasing the corporate stock. Let's now talk about fraud. Common law liability for fraud is available to third parties in any jurisdiction. The third-party plaintiff must prove a false representation by the accountant, knowledge or belief by the accountant that the representation was false, that the accountant intended to induce a third party to rely on false representation, that the third party relied on the false representation, and that the third party suffered damages. A common law fraud case that explains these requirements is Pacific Mutual Life versus Ernst & Young. In this case, Ernst & Young issued a report stating that the audit of Republic Bank Corporation was conducted in accordance with accepted auditing standards, and that the financial statements fairly represented Republic Bank's financial position. This information was later included in documents filed with the SEC, which discussed a potential merger between Republic Bank and InterFirst Bank. Following the merger, Pacific Mutual Life Insurance purchased non-investment grade InterFirst notes, debt securities issued by InterFirst, which were later rendered effectively worthless when First Republic Bank Corporation, the merged entity, experienced financial problems and filed for bankruptcy. Pacific Mutual sued Ernst & Young, alleging that their 1986 audit report was materially false and misleading, that Ernst & Young knew that it had not followed auditing standards, and that they breached the auditing standards of independence. Court sided with Pacific, stating that Pacific only needed to show that Ernst & Young intended a particular class of persons to rely on its representations, and Pacific was a member of that class. To establish liability for fraud under Section 10B of the Securities Act, a plaintiff must show that the defendant made a material misstatement or omission. The statement or omission was made with an intent to deceive, manipulate, or defraud, which is called scienter. There is a connection between the misrepresentation or omission and the plaintiff's purchase or sale of a security. The plaintiff relied on the misstatement or omission, and the plaintiff suffered economic loss. And then there's a causal connection between the material misrepresentation or omission and the plaintiff's loss. An important case in this area is State Street Trust Company versus Ernst. In this case, the auditors issued an unqualified opinion on their client's financial statement, knowing that State Street Trust Company was making a loan based on those financial statements. A month later, the auditors sent a letter to the client indicating that receivables had been overstated. The auditors, however, did not communicate this information to State Street, and the client subsequently went bankrupt. The New York court ruled that the auditor's action appeared to be grossly negligent, and that reckless disregard of consequences may take the place of deliberate intention. In such cases, while fraudulent intent may not be present, the court constructs fraud due to the magnitude of the negligence. In Farmore versus Coopers and Lybrand case, the auditors were found guilty of fraud under both common and statutory law, even though the plaintiffs acknowledged that the auditors had no intent to deceive. Instead, the plaintiffs successfully argued reckless disregard for the truth, which gives rise to the inference of fraud. In the next two cases, the court ruled that an auditor can be found guilty of fraud if the plaintiff can prove that the auditor was aware of the auditor's misrepresentations, and they might be relied on by the plaintiff. The plaintiff doesn't need to prove that the auditor intended to have the plaintiff rely on the misrepresentations. Let's now talk about the last topic in terms of auditors and accountants' legal liability. Accountants' legal liability also extends to personal tax fraud and negligence, as well as permitting and or enabling the tax fraud of a client. Income tax fraud is the willful attempt to evade tax law or defraud the IRS, and the accountants need to know about tax fraud and tax negligence, whether on the part of a client or themselves. Tax fraud occurs when a person or company does any of the following: intentionally fails to file an income tax return, willfully fails to pay taxes due, intentionally fails to report all income received, makes fraudulent or false claims in preparing the tax return, or prepares and files a false tax return. When a careless error occurs, if signs of fraud are absent, the IRS will usually assume that it was an honest mistake rather than a willful evasion of the tax code. In this circumstance, the mistake is typically attributable to negligence. Although unintentional, the IRS may still fine the taxpayer a penalty of 20% of the underpayment.